The US dollar index is under pressure, trading near 103.60. Meanwhile, traders are anticipating Jerome Powell's speech. In this connection, the end of the first week of spring promises to be extremely volatile. We have 2 days of a testimony from the head of the Federal Reserve before the U.S. Financial Services Committee. Today, Powell will have to start explaining to lawmakers facing inflation-worry constituents why he is confident that price pressures will ease without destroying the labor market, or conversely, why the window for a soft landing is closing. The Fed chief is expected to stick to his hawkish scenario. A slowdown in the services sector and the surge in the new orders further clouded on an already fuzzy macroeconomic picture. Gold and Bitcoin jumped to record highs, and this underscores the level of unease about inflation and debt that has driven investors into supply-constrained assets. Reports supporting a scenario of a soft landing, such as Tuesday's strong services price data or signs of a slowing consumer spending, have been offset by rising housing costs and excessive job gains in January. Many economists believe that any shift in the Fed's outlook is likely to be toward favor and later rate cuts. In any case, we are getting ready for 2 days of intense analysis of the Fed's signals. In addition, this week will offer high volatility, and the ECB rate decision and a fresh snapshot of the labor market still on the calendar. In our video review, we will tell you which macroeconomic releases are important to watch. You are watching the Trader's Calendar. On Thursday, markets will focus on Asia. The day will begin with a report on Australia's trade balance. On Wednesday, the Australian dollar climbed above 0.65, bouncing off 3-week lows and taking advantage of a weakness in the US dollar. However, we should keep in mind that fresh data showed Australia's economy grew at a snail's pace in the December quarter, as a sharp drop in a household income brought consumer spending to a halt. Annualized GDP growth slowed to 1.5% from a 2.1% in the previous quarter, and the lowest rate since the economy emerged from a recession in early 2021. Net trade was a key driver of growth, with a fall in imports as Australians spent less money overseas, added 0.7% to GDP growth in the fourth quarter. Traders will assess fresh trade data as early as Thursday. Data for December showed that Australia's trade surplus fell to 10.96 billion Australian dollars, as the exports rose less than imports. The market is expecting the surplus to rise to 11.42 billion. If the data comes in line with the forecast, it could support the Aussie, while signs that the economy will continue to slow in the coming months could argue for the Reserve Bank of Australia's first rate cut in August or earlier. During the Asian and European session, assets will likely be driven by the release of a similar report in China. As the traders have not seen any clear signals in China's latest economic growth rates and the policy plans, the report may give the offshore yuan an additional boost. China's Premier Li's vision of economic development contains an inherent contradiction. His goal of transforming the economic model may be incompatible with keeping growth rates stable around 5%. And in his first report, Li pledged to expand domestic consumption while curbing industrial overcapacity, local government debt risks, and supporting only justifiable real estate projects. These promises would have been music to the ears, but local government debt for infrastructure projects, real estate overcapacity, and manufacturing investment have been among the key pillars of China's economic recovery. Against this backdrop, the offshore yuan fell to as low as 7.21 per dollar. Traders expect Thursday's data to confirm a sharp rise in China's trade surplus from $75.34 billion in December. That was the largest trade surplus in 3 months as exports rose more than imports. The market expects the surplus to rise to 110.30. If the data is in line with the expectations, it could help the yuan recover its losses. The main event for the currency markets will be the ECB meeting on Thursday. The focus will be on whether policymakers will reiterate that it's too early to discuss a rate cut or open the door to such action. Rates have been unchanged since September, and the ECB has dismissed talk of a cut, insisting that even if the next move is a rate cut, it will come later than the markets expect. After all, wage pressures remain high even if they are reduced. So, instead of a 150 basis point cut in early 2024, markets are now pricing in a 90 basis point cut, with the first move fully scheduled for June. Earlier, Governor of the National Bank of Slovakia, Peter Kazimir, said that the ECB would acknowledge the improvement in the inflation outlook on Thursday and avoid any commitment to rate cuts for now. Bank of France Governor... Так, можно вот отсюда Bank of France Governor, а то что-то меня это повело. Bank of France Governor François Villeray de Gallo said that it's not a question of a ration, but action gradually and pragmatically can be preferable to deciding too late and then having to adjust. Lagarde stressed that the ECB should avoid cutting rates too soon, as this could prolong high inflation. Even Governor of the Bank of Greece, Yanis Stornaras, believes that the optimal time could be the end of the first half of the year. The ECB has signaled out wages as the most important factor is determining whether it can cut rates. However, fresh first quarter wage data, which is crucial, will be released in May. Economists also expect downward revisions to growth and inflation forecast for 2024. Growth in the Eurozone has been hovering around zero for the 6th quarter in a row, and the European Commission has just cut its GDP growth forecast for this year to 0.8% from a 1.2%. Thursday's rate decision itself, as you can imagine, will not have much significance. The bank's statement will be the main focus. Continued hawkish rhetoric may support the euro. However, softer or more dovish comments will only reinforce the market's hopes that the ECB will reverse course before the Fed. In addition, traders should keep in mind that Powell will continue the second day of his statements on Thursday, and it's worth looking at the full picture when choosing a strategy. Friday's trading will be dominated by a number of employment reports. In particular, fresh data will be released from the United States and Canada. The Bank of Canada is expected to keep its key overnight rate unchanged at 5%, despite data pointing to slowing inflation and economic growth. Inflation has remained stubbornly above the Bank of Canada's 2% target for 3 years. Despite interest rates at a 22-year high, the Canadian economy has so far avoided recession and may be gaining momentum. After January's inflation data, the money markets raised their bets. They now see a 44% chance of a rate cut as early as April and fully expect a rate cut in June. Last week's fourth quarter GDP data showed that the country's growth beat expectations, accelerating to an annualized rate of 1%, driven by exports. The Canadian economy added 37,000 300 jobs in January, more than a double economists' expectations, while wage growth slowed slightly. Statistics Canada said that the unemployment rate dropped to 5.7% from a 5.8% in December, the first decline in the 13 months, partly because fewer people were looking for work. Now, analysts predict a 15,000 increase in jobs and a rise in the unemployment rate to 5.9%. The labor market still appears to be resilient. If the data matches the forecast, the Bank of Canada will have more of an argument to maintain its pause on interest rates, potentially supporting the loonie. U.S. employment and wage data will round out this series of important reports. As of today, the U.S. unemployment rate stands at a low 3.7%. Inflation is close to the Fed's 2% target, and the economy continues to grow despite the central bank's tightening. However, the Fed's next steps remain uncertain, as recent inflation readings have been more resilient than expected. Some Fed officials and outside analysts worry that the U.S. economy remains too strong for price pressures to fully abate, arguing for a longer than expected delay in rate cuts. The Fed's predicament is that despite holding interest rates at 5.25% and 5.50% since July, the highest level in more than 20 years, overall financial conditions are softening and asset prices are rising on expectations of a Fed rate cut. During the testimony of a subsequent hearing before the Senate Banking Committee on Thursday, investors will be closely watching any attempt by Powell to change rate cut expectations, with the final word coming from the jobs data. The U.S. economy added 353,000 jobs in January, well above market forecast of 180,000. It was the strongest job growth in a year, indicating that the labor market remains tight. Based on the fresh data, economists expect the U.S. economy to add 188,000 jobs. The U.S. unemployment rate stands at 3.7%, just a few tenths of a percentage point higher than it was when the Fed began raising interest rates in March. The U.S. dollar index will be helped by any signs of a sustained strength in the labor market or early wage growth. Otherwise, the greenback could continue to weaken. Notably, the entire pool of labor market reports should be evaluated with an eye on the impact of each one on the persistence of inflationary pressures, taking into account the latest statements by the Fed chief. This was a brief overview of the most important economic events from InstaForex analysts. Follow us and make hefty profits from your trades. So see you online soon.